Hey guys, welcome to the podcast. It's a Saturday morning, doing kind of a special podcast. I just couldn't get to a podcast during most of the week, and wanted to make sure I got something out to you because there's a lot of stuff going on in the stock market right now, obviously, and for the most part, it's all pretty good. And as we continue to move up here, as you see the stock market, on the S&P moving up, breaking out, and there's a lot of, some people would say complacency right now. It seems like investors are simply ignoring any bit of bad news and just buying stocks. But, we have to realize a couple of things. Number one, that we are seeing growth has stabilized and is not decelerating anymore. Remember, going back 2-3 months ago, we were worried about a recession. Very prominent economists were calling for a recession. We were worried about the upcoming election and how that might affect people's spending habits, how that might affect overall confidence. We had Obamacare. How was that going to play out? We had Europe was still seeing interest rates spike up. And then, of course, we saw China slowing down quite a bit. And so given that, it was a time to avoid stocks. And that's what we saw from September all the way through, most of November was a pretty decent, maybe about a 10% correction, and enough to get people kind of scared. And then what ended up happening was obviously the election did come and go, and we did get an acceleration to the downside. Then we started to rally, kind of coming into, coming into December, and then the focus obviously turned towards the fiscal cliff, and it was, day by day getting closer and closer to this deadline, and they came out obviously and did their deal with taxes, didn't really address spending. So the market now had checked off the election. It had checked off the fiscal cliff. Europe was on the back burner at least, and maybe put a Band-Aid on that for the time being, and so it wasn't on the front headlines every day. China started to report good numbers. We started to see housing continue to improve. And so overall, I think the global economy at least stabilized. The deceleration we saw and the growth rate stabilized. And so given that, stocks were, reasonably valued, and up we went. The key through all of this was the fact that, and I've been saying this the last few podcasts, that we didn't see a lot of evidence of an imminent bear market. We didn't see some of these classic signs we see, going back to '07, where you start to see stock by stock, sector by sector start to break down and enter their own bear market before the overall market does. Supply and demand still remains very healthy. So even through that, we're getting some correction, but you couldn't help but feel like, hey, the stock market could go down much further given that, look what it did in the summer of 2011. Remember, the summer of 2011, we had this big, right over here, it was a 22%, I believe it was a 22% drop from here down, ultimately down to here. That was a big drop in a short amount of time. Now, it all had to do with the debt situation, and of course the U.S.'s debt was downgraded by Standard & Poor's. And so, at the time where this was happening, it started to feel like that again, right? And it ultimately ended up being more of a correction, but it did feel like that. It felt like it was starting to accelerate to the downside. Of course, we broke through this 200-day moving average, and a lot of people felt like that was it. You started to see Apple breaking down and some of the leadership breaking down. But lo and behold, the stock market fooled everybody, reversed course, started to head back up again. And again, we checked off some of these things that were worrying us. One thing we have in front of us still are these debt debate, spending cuts, the debt ceiling. These things are, again, right there, and we could see some volatility, but we're already seeing the House potentially, Republicans saying we're going to a 3-month debt ceiling increase. We don't want the government to shut down. So the stock market, again, is celebrating that. Now, when we look at the stock market here, generally, given the S&P 500, we have to start looking at the fact that it is broken out, obviously, and it broke above this 1, 2, 3, 4 times it tried to get above, and it couldn't. Finally, it did. Where is it going? Well, that's when you have to shift to the weekly view. And if you look at the weekly view and we go back, now we start going back to the old peak of 2007, 2008, back in here, and that level is roughly We'll just we'll call it roughly 1523, 15. Why even do it rough? Let's get an exact, which looks like the high was 1576. So 1576 is an area that, again, if you're looking at this long term, you'd say, well, this thing's moving up. Surely it's going to test that. And it probably will, especially if you do some math and realize that, when you look at some of these pullbacks, sometimes markets rally. The difference of what this high was to this low, you add that on from this breakout period. Some of that gets you up to this level. But, again, in the short run, we have to realize what's going on. And what I'm seeing right now is I think we're very close to a short-term top, very, very short-term. But it feels like we're getting to that point based on several complacency oscillators that I watch. And I know those are kind of, sounds like hocus-pocus words when I say oscillator. But things that, like a pendulum, swing back and forth from ultra bearish to ultra confident. When you start looking at the stocks making new highs versus new lows, some of those ratios, you look at how many stocks are above their 10-day moving average, their 40-day, 50-day moving average. And when you start looking at the whole market and say how many stocks are moving in the same direction, when it gets up into the 90% range and things like that, you have to start and you have to pause, because just like when only 10% of the stocks are going up, that's a buy sign, because they're all moving in the same direction down, and that's time to actually buy, times like this. But when you get up here and everybody agrees it's going higher, the VIX is plummeting, and nothing can go wrong, that's when you have to not let your guard down and realize that we're probably due for a correction. Now, the thing you have to decide is a correction noise and just vibration, or is it a correction that's like last summer where it goes down 15, 20, 25%, which then is technically a bear market over 20%. Which one is it going to be? And I'm in the camp of saying it's going to be a correction. But I think it's coming fairly soon. And of course, when that happens, the first thing you would look for is for it to pull back, break down back below here, and hit this uptrend line here. Again, a mild correction, but if that happens, that's where you look to add some positions. Now, the other scenario, obviously, is that it continues to climb and it doesn't give you that chance to get in. And a lot of people feel like that right now. A lot of people were sitting out all through prior to the election. I'm not going to do anything until after the election, after the fiscal cliff, and now they have all this cash. How do I get it invested? And one way to do that, obviously, is to average in, and I think that's why you're seeing the market continue higher. But if you look at things like the transports, what if the stock market did this? What if it just continued to climb? And this is a Bollinger Band here. These are two standard deviations away, and you can see that generally the market stays within those bands, but occasionally when it gets outside of it, those are, a buy sign when it gets to the low side and a sell sign when it gets to the high side. This thing is continuing just to ride it up here, and that's bullish. That's great. But the point is that what if the stock market did that? This is the transports. What if the overall stock market rode that up and didn't give you that chance to get in? So I think if you're way underinvested, there you do have to average in and say, hey, maybe we don't get that pullback right now when we're quote-unquote supposed to. If you're somebody that has a reasonable amount invested, you're making money on these days where the market goes up, then you can afford to be a little patient and wait for some of these extremes to work themselves off. And we are getting there. There's several things that I monitor, and now I'm starting to get some, and I've got them color-coded so they're easy to see, but I've got some of these things that are usually a neutral color turning to red. It's kind of like a dashboard. It turns to red and says, hey, Karl, these things are in these extreme areas where you've seen corrections before. And we're getting to that point. They're not all flashing like, for example, in September when they were very extreme, but they are getting up there. Some are extreme, some are not. But the point is, I think we are setting up for some type of correction. And again, I don't know at what level it'll come, but I think we're very, very close right now. But given all that, in the big picture, things have improved. And so it does make sense that you're seeing a rotation back into, growth-type stocks, growth-type sectors, the stock market in general. And what are we doing with interest rates? Well, interest rates, again, have kind of been muted. You would expect them to be racing up right now as money's coming out of bonds into stocks. That's not really happening. They've moved up, in the last month or so, but not dramatically. And I think that that makes sense. I mean, look, we know what the Fed's doing, and they're going to continue to do it. So people still aren't buying it yet. So there is still money coming into treasuries, maybe on the margin, a little more money coming out than in. But overall, when we look at these different sectors, I mean, look, you've got semiconductors breaking out, right? This was in a kind of pattern here that you can see that I've drawn. They have broken out. Obviously, we've already talked about transports, and they've been extremely strong. That's something that's very bullish. Small caps, new highs. Mid caps, new highs. Financials, new highs. Discretionary stocks, XLY, new highs. I think even the staples are new highs. So it's not just the discretionary. I think utilities have struggled a little bit, not near new highs. They have a ways to go. But again, that's not an area I'm in right now. I was in it for 2.5 years probably. And when it broke down here, we waited for it to bounce a little bit, and we got out somewhere in this area, I believe. And so, and it's been gyrating back and forth since then. But again, you have to remember that's being used as a source of funds because, yes, people want dividends. They want dividends. I mean, you have the S&P right now with a dividend yield of, let's call it 2.8%. They want dividends. But unlike last year, when they thought taxes were going to go up a lot more on people over 250, now it's 450. When they thought the state tax was going to do what it's going to do, and of course they increased it to $5 million as an exemption. So things could have been worse from a tax standpoint. And so last year you saw dividends really lead the way. Now what you're seeing is a shift from dividends to more of the growth areas. I mean, take a look at, AT&T, which is struggling. And, if you look at the 100-day moving average, it's rolled over. And, of course, it broke through it, and it hit it, and it failed. 5.3% dividend yield on AT&T, and yet the market's selling it on heavier volume, by the way. Is it in sympathy because of Apple? Maybe, but I think it's more a function of people saying, I think I can make more money in a growth stock than I can in a dividend-paying stock for 2013. I think that's what they're saying. And it's the same thing if you look at Verizon. Again, almost a 5% dividend yield, but a stock that has been very choppy and not really participating in this rally. Altria Group. I got this little red arrow. This is where I had sold it in the past, and I've been wanting to buy it back, and I haven't. And you can see it's much lower than it was. Maybe at bottom, but again, is it participating like the transports? No, it's not. And so you have to be careful, again, of being, even if you're in the market, being too defensive from a standpoint of owning utilities, staples, high dividend-paying stocks. I think high dividend-paying stocks will still do fine because if you're somebody that's sitting there in a CD that came due and matured, you start looking at your options saying, do I roll it back into a new CD at lower rates? Let's say you've had a CD for 6 years, 5 years, and it came due, and now you're having to roll it into something new at a lower rate. What are your options? Well, your options may be a new CD at a lower rate or a bond, or you say, you know what, I'm going to go ahead and just buy a dividend-paying stock. So I think dividend-paying stocks still will work, but it's on a relative scale that they're not. Now let's take a look at gold real quickly here. Gold, I think, is at a pretty interesting spot, and I think it's breaking out. This is a kind of a pattern I see when I look at it. Had a slightly down day on Friday, gapped up in the morning, and then sold off in the afternoon. I like gold. I think gold overall, when you look at what's happening, some people are selling gold because the economy is strengthening. That means the dollar would be stronger, and that means that gold should be sold and bonds should be sold. Well, let's just look at the big picture, though. Why is the economy strengthening? I'll give you 2 more seconds to answer that. The economy is strengthening primarily because of all the injection of capital being put in by the Federal Reserve the last several years. And not just here, but around the globe, right? So everybody is in this, what I've talked about being the race to debase their own currency. So everybody's trying to cheapen their currency. As you're seeing the yen fall, you're seeing all these things fall. And so in general, is there more money printing around the world? And are fiat currencies, in higher demand or more supply? They're in more supply. So gold still works, in my opinion, but I'm not really trading it. It's something that in one of my strategies is kind of a core piece. It's not a big piece at all, but it's enough to be something that's kind of zero correlated to the market. It is kind of an insurance policy, but it's not a huge amount. For people who have 30% of their money in gold, has not been the place to be and may not be the place to be. But I think right now, even in the short term, it is breaking out a little bit. And I don't think it's time necessarily for the gold miners. If we look at the gold mining stocks, they haven't. I've got this pattern here, and some of this is maybe coming to a head. You can see I drawn an uptrend line where it's bounced off of a few times. Then we've got kind of this longer term downtrend that it broke above, and now it's back testing again. And then secondly, we've got this this little wedge pattern. So everything's kind of coming to a head somewhere in this area here. Okay, and so we need to watch gold miners. They could be on the verge of breaking out, especially if gold can stabilize and keep going higher, as people may rotate and take some profits in some other areas, maybe come into the gold miners. So watch for that. But again, I'm not in this area, but it's an area that I'm watching closely because I think it eventually will break out. Let's shift over to Apple real quickly. A lot of people ask me to comment on Apple. Apple's a stock I have owned for a long time and continue to own. Like the fundamental story. As I've said in prior podcasts, I've acknowledged the fact that, well, selling it at 700 would be better than keeping it at 500. That's fairly obvious. But I've acknowledged in prior podcasts that I do think there's been a slight shift in Apple as far as their fundamentals not being quite as good as they were 6 months ago or a year ago. I think we need to acknowledge that. And if you do some real hardcore fundamental research on Apple, as I've done, you will acknowledge that as well and say, you know what? Is it quite the company it was 6 months ago? And I am saying no, but that doesn't change the fact that it's still a buy. And the reason why is because I don't think the company has deteriorated fundamentally as much as the stock has. The stock's gone down faster than the fundamentals have. Some people believe that the iPhone sales have peaked. Some people believe that there's cannibalization, which was a fear because they have the iPad mini, and now it's eating into sales of the iPad 4. Again, though, we need to wait and see what are they innovating. We know in June there's probably the iPhone 5S or even an iPhone 6. It's every 6 months we know they come up with something different. Is it going to wow? iPhone 5 did not wow anybody, and so that was part of the problem here. But, again, now you've got this battle, and it's kind of funny because you're seeing some capitulation here by some of these analysts downgrading the stock. These are all guys that have, ratings at $800, $900, $1,000, $1,100 on the stock and are now saying, we're going to downgrade it. Now that the stock's fallen from 700 to 500. This is the time something need to step up and say, we're upgrading it. It did what we thought it was going to do, and now now it's more attractive. I do think, though, when we step back and look at Apple on a daily picture, this is the area that is a downside potential, kind of the 430 area. And that's another 15% down. And it wouldn't be a pleasant ride. But again, one positive here is that Apple is working off the wow factor, the cult factor of everybody having to own Apple and it can't go down. Those people are starting to exit and going, it's kind of like the person that's dating different girls, looking, bouncing from girl to girl. Apple is not as attractive as it was, a few months ago. And I shouldn't say attractive because obviously 500, maybe it's more attractive than it was at 700, but it doesn't have that wow factor anymore. I mean, look, the stock market was up 53 points yesterday on the Dow, NASDAQ, and the S&P and the Russell, and those things were going up, right? But not the NASDAQ yesterday. But generally speaking, if you look at the NASDAQ 100 and technology and all of that versus an unweighted NASDAQ, you will see that the big reason the NASDAQ's struggling is because of Apple. Apple's still like 20% of most of these technology indices. It's a 20% weighting. So as Apple goes, it goes. If you look at an unweighted technology's doing fine. So, but it's worn off that wow factor. But my point is that the market's going on without it, and that was something that did not happen. But this really started back in late September that we saw Apple peak, and now it's been underperforming the stock market ever since. But you have to again step back from it, look at what they're doing, acknowledge what's been happening, but then just realize what can you buy with your dollars. and I still think Apple is a compelling deal. So for me, it's not a trade. Otherwise, it would have been sold. It's an investment. And there's a lot of things in my portfolio that are trades, but there are some that are investments. And Apple, people can argue about it technically what it's doing, but I think it's still a great fundamental company. When you step back and look at this, I mean, this thing since '04 has been a monster, and it's not, again, if we were to take this line and extend it out, you can see that kind of 430 may be that inflection point where it's continued to work sideways and so forth, and it works its way down over time, and it gets to the 430 range. And then at that point, we'll have another quarter or two of earnings. Maybe they increase their dividend, they do a stock buyback, and then the fundamental story is priced in there, and it starts to move up again. It's almost like a gold picture, right? Gold has its struggles, but generally the uptrend has not broken. Same thing with Apple. So that's my take on Apple right now. Now, if we look at the volatility index, volatility is getting crushed again and is at a level not seen since way back in '07. And just for those that missed the prior podcast, this is a weekly picture. One thing I'm going to point out to you is that you look at this time frame here from '05 to early '07, the VIX spent a lot of time down in the 10 to 12, 13 range, a lot of time. What if we're entering a new phase like that? What if that's happening? If that's the case, we may have a lot of time in 2013 and 14 where the VIX is just low. So that wouldn't be, A, that wouldn't be a bad thing, but B, you have to look at where you are and realize that we were in a very elevated volatility level for several years for several reasons and legitimate reasons. But what if the economy continues to, the American economy grows at 2%, 2.5%, maybe even 3%. Stocks are reasonably valued overall. You can get a good bang for your buck in dividends. Interest rates are held down by the Fed for the next at least 2 years. China continues to grow. Housing continues to recover. The initial jobless claims yesterday was the lowest level going back several months or years. And the trend continues to be favorable there, even though, again, it's not the types of jobs we need. It's not enough jobs, but it's going in the right direction. What if all that continues? Then, yes, we could see a volatility index continue to fall, meaning there's just not a lot of vibration in the market, and the market continues to meander on up, which makes circling back around to what we talked about at the very beginning of the podcast, it makes getting back into the market, for those of you that are sitting out, difficult, because what if it continues to just low volatility and the market just continues to do this, maybe a 2-day pullback and do this? That could happen. We only have to look back to last year, the beginning of the year. Most of the gains for the stock market were made in January through April. And, look, this was a straight-up move. It did not, it had one little correction. And that was coming off of, by the way, again, that very scary summer, right, where everything fell. Let me go back a little further. Everything fell dramatically. It was bouncing around, chopping around. And then, in January, it was like nice and smooth. The volatility dropped, and up we went. So what if we have that type of environment right now, where it kind of lulls you to sleep, and we just keep going up? I think that's a high possibility. But again, to reiterate, I think in the very short run, we get some type of pullback, or at the very least, a sideways time where you're still okay holding some cash and looking for better deals. But there's been a lot of areas. I think, one of my holdings I've had for several years, Kinder Morgan. You look at this stock, very volatile. But this is a perfect example of what happened last year, coming into and after the election. Kinder Morgan dropped dramatically, and again, this has a 6% dividend yield. They just raised it the other day. They raised their dividend something like 12 to 14% a year, something like that. I think that's it. Maybe around 10, something like that. But anyways, the point is that they're raising their dividend or distribution out. It's not a dividend, it's a distribution, but they're raising that up much more than inflation every year, whereas a 10-year treasury, obviously you get no raise in the amount of income you get from that treasury bond. So this is something where the distributions far surpass inflation, and yet the stock gyrates. And partially this red arrow, why it went down, was because people were worried about the fiscal cliff, taxes being changed, and the way that partnerships were going to be taxed. And I never felt like that was going to happen. I thought at the very least, obviously tax rates could go up on the high end, but they weren't talking about this in this round. This is something for the back burner that we need to watch, because eventually they could change the way they're taxed. So all this money came out, and then it kind of bounced back. Things got oversold, but then it sold off going into the fiscal cliff. And then once the fiscal cliff was resolved, look what's happened. It's gone straight up. Had a huge move from 77, and the stock's at 89 right now. Big move for Kinder Morgan. So all the partnerships have recovered. So a lot of that money that came out of some of these sectors and areas is now going back in. In fact, I think the week before last, we saw $8.9 billion go into long-only stock mutual funds. Okay, that is a huge number. That is the biggest increase we have seen since the year 2000. Now, the bears will look at that and say, well wait a second. What was the year 2000? So it's coming back to me slowly but surely. What was 2000? 2000 was, yes, you guessed it, the stock market peak. This is 2000. So that's when all the money was coming in there. It was a contrarian indicator. But my point is, by the way, kind of sad when you look at the volume here. This is a big concern. But you have volume decreasing, but it's been decreasing. So if you would have used that as your metric here, you would have missed out on a lot of this run. It's the quality of the volume. We want the quantity, but it's more importantly the quality. But I don't want to get sidetracked. But the point is that money has been flowing back in the stock market very fast. And I wouldn't get necessarily too excited to say, hey, there was the most money coming into long-only stock mutual funds last week or 2 weeks ago since 2000. What I would say is there was a lot of money that came out. $150 billion came out of stock mutual funds last year, partially because it went to ETFs, partially it went to bond funds, partially it went to cash. And a lot of people were scared, right, coming into the election and everything and coming into the fiscal cliff. I think a lot of that money is just coming back in. I think it's the same money circulating, coming back in, and getting recycled. So I wouldn't get too excited about that money coming back in. But the fact that it is coming back in is pushing up stock prices. And again, what you want to see in this market is a spreading out. And that's what we have. We have financials doing well. We have REITs doing well. We have semiconductors doing well. The transports, very cyclical, doing well. You have the steel stocks, even the coal stocks have stabilized, which have been in a bear market. They have stabilized. You have green energy stocks going up. You have solar stocks doing very well. So my point is that this is spreading out. And one thing we look for, and this is very important, is you look for a stock market that is narrowing. And if it's narrowing, then you start to say, hey, you know what? If it starts to get narrow, usually that precedes a bear market by about 4 to 6 months. The market is making new highs on the expansion. Things are spreading out, and that's exactly what we want. So again, what I'm looking for is to get any cash that I do have, get that more invested at appropriate times in appropriate areas. And I think right now I'm looking for some type of pullback, but if we don't get it, I do have money invested. And that's the key, that if you're somebody that has way too much money on the outside, you're going to have to start to average in a little bit. And that's just how you're going to have to do it, because otherwise, the train may be leaving the station. But as always in this market, have your strategies in place, your income portion, your trading portion, your investment portion, maybe some sectors you rotate in and out of. All those come together nicely, but have all those pieces and don't let your guard down, because one stupid move by Congress, or should I say another stupid move by Congress, could cause this market to turn right around and head straight down. Remember, we've got a downgrade warning out there, by Fitch, I believe, that could downgrade us anytime and say, hey, we're taking your AAA rating away. Standard & Poor's already did it last summer, so wouldn't be the end of the world, I guess, but it would certainly put a damper on things. So we have to watch out for that. So don't let your guard down, but do acknowledge that the stock market has been strengthening, not only from, yes, the surface here looking at this picture, but underneath the hood. Okay, it's got a little better engine in it, a little more horsepower than it did before, and that's very encouraging. So, All right, guys, 30-minute podcast. We're going on over 30 minutes here, a little longer than normal, but it's the weekend, and it's early in the morning, so I had a little more time. Hey, don't forget KarlEggers.com, Eggers Capital. If you haven't been there in a while, go check that out. We have some reports. We have some. The site was redesigned a few months ago, so everything's on EggersCapital.com. Of course, we're on Facebook, Google+. And then if you want some updates throughout the day, just opinions from me, certain things I'm seeing, different reports coming out, it's twitter.com/Karl Eggers, KarlEggerss. Thanks for joining me. Appreciate it. And have a great, wonderful rest of the weekend.